Really quick to introduce this video, we got Justin Elliott from Minneapolis, Minnesota, and Steve Chan out of Houston, Texas. We're going to talk today about how they came in and closed on this 28-unit apartment building in Augusta, Georgia. And I think the purchase price is $1.4 million on it. Incidentally, I hit the record button a little bit late on this particular video, so we're going to miss about the first 2 or 3 minutes of the actual presentation, but there's enough in there that you're going to get a pretty good idea of what's going on. So that said, enjoy.
$40,000 in CapEx. The total raise ended up being $850,000. Had good occupancy coming in as far as physical. And then we did a $50,000 minimum investment. We ran the numbers for a 5-year hold. So we'll talk more about what the returns look like.
Okay.
So the executive summary, really for us, it was all about buying, at the right time in the right market. And Bernie really got us excited initially. I didn't really know that much about Augusta. I'd been looking at parts of the Southeast, but Augusta wasn't really on my radar. And it was all about this cyber center, right? And that's what a lot of people were talking about. So basically, Fort Gordon, which is the U.S. Army base down there, they brought their cyber command to that area. And what's happening around that is a lot of ancillary services come into the area to support that. So they built these 2 buildings you can see in this top circle is this U.S. Army Cyber Command Center. Basically, it's buildings that they're leasing space to vendors that are moving down from parts of DC and other areas to help support that with the U.S. Army. But it's becoming this kind of tech cyber hub. So when you go to Augusta, if you're in the airport, you'll hear an announcement come on, and it's the mayor or whatever, and talking about, hey, we're becoming the world's really cyber command center, the center of cyber tech for the world. And that's really their plan here. And they're putting a bunch of infrastructure behind it, and it's doing good things. There's other things that they're doing. They're building an Amazon distribution center that they broke ground on that's bringing a bunch of jobs. And, it seems like pretty routinely now I'm on all the news feeds, you get good updates about what's going on, and there's a ton of support from the government. So they've got this nice mix of like government helping the private sectors out, and they're really looking to grow. Not a big city, it's 200,000 maybe, but it's a pretty big economy as far as the area goes. So.
And I'll just chime in from a military perspective. The DoD in general is really amping up their cyber capabilities. And I think recently, warfare, the way we wage the next war is going to be completely different than how we did the last war. And it's going to start over the networks. It's going to be trying to shut other people's networks down, because we use the internet for so much of our communications and our traffic and everything that goes through that. So the DoD has invested a ton of money into their cyber capabilities. So the Army Cyber Command moving into a place is a really big deal. And the DoD is committed, I think, sorry if I'm stealing your thunder, but $1.6 billion in the next 8 years into Augusta and Fort Gordon.
Yeah, we have a CoStar report on it as well. And it says overall growth is expected to raise the number of jobs by 250 to 375 and at for the next 20 years. So, yeah, pretty impressive.
Yeah. So
the team, I mentioned Bernie. Bernie lives in San Diego. He invested in Augusta. He's a Naval Academy graduate. He's actually a assistant pastor at his church out there, but he also joined the mentoring program with Drew Whitson, who coached all 3 of us at one point. Steve, he kind of gave you his intro, but interestingly enough, Steve and I right now work for the same company, the same med device company. We've kind of got a similar background, and we decided before doing this deal that we wanted to partner up on something, and so that's what we did. I mentioned myself and then Drew Whitson, who's also up here in actually St. Paul, and syndicates a bunch of deals in Memphis typically. But I think just to speak briefly about the coaching program, I always get a lot of questions about this. Is it worth it? In my case, it has been. I've found it to be pretty valuable. I think coaching, I'm a fan of it. I support it. I probably wouldn't have got either of my first 2 deals if it weren't for my coach. He obviously put us all on this one, but then right after I closed this one in August, I got a text from him one day and he said, "Can you raise 250 grand today?" And of course I said yes, because what else are you going to say when your coach texts you that? And so boom, I was kind of I'm in my next deal, and had an opportunity to raise capital on the next one and help get one closed out. So for me, the connections have been huge. But as anyone will tell you, you don't just hire a coach and good things happen. You have to really put the work in. The amount of work you put in doesn't change. It's just going to kind of help you get to where you're going, I think, a little faster.
Do you mind if I say something about that too?
Yeah.
So I think there are a lot of coaching students that struggle. And I think that it kind of has to be a two-way street. You don't want to hire a coach for a coach to do everything for you. You want to be in a position that once you do hire a coach, you're ready to close. So you've already educated yourself. I mean, there's so much free content that's available. Like just between Brian and Jerome, if you guys were to listen to all their podcasts, you would have a phenomenal foundation of knowledge just from that. But then there's books, and then a lot of these networking events, you can get your baseline education. Our coach really helps is wherever you have a gap. And so to get, a loan from Fannie or Freddie is difficult, and you need credibility in that market. So one of the things I think is the biggest takeaways from that is that when you go into a coaching program, you also want to impress your coach. You want to prove to them that you can be a valuable business operator, because you might just end up in a deal with your coach.
Mm-hmm. And that was the case here. So Drew is a GP on this deal. He helped us with getting the loan, and that's not always the case. I know, some coaches will do it, some won't. In this case, it worked out. So that was worth the price of admission. The property manager, Philip, he's with Aubin Property Management. This is a little picture you can see there, literally directly across the street. We love this part of the deal because he walks out his office every day. He looks at our 29 units. And so we actually have tenants that will go over there and pay him rent with a check. So it works out nicely. We ended up even painting the buildings similar color just because it kind of made it look like we had on-site property management. But he was the par 3 superintendent at Augusta National. And last week he actually took the week off because they called him to work at the golf course for the week. So he did that for a long time and was investing in real estate himself, and found out about this gig. And for the last, I think, 4 years, he's been doing this. The company Aubin had been owned by, and is owned by someone that had started a property management company. They grew it to 7,000. They sold it. And so they're trying to do the same thing. They're not huge. They do a lot of single family. They've got a few in this 20 to 30 range. They don't have anything that's 80, 100 units. But they've got technology and systems and processes in place that are they're bigger than their actual company. They're thinking ahead because they want to grow there. And for us, it was a good play because they saw us as an opportunity. People that are syndicating deals, coming into this market, wanting to grow. We kind of positioned as like, let's grow together. And they had the systems in place to do that. So far, so good with this property manager. We're out of the honeymoon phase. We're definitely, we're working on getting this thing leased up, and they've been very responsive and done everything we asked, though. So it was good. And of course, they found the deal for us, and they really wanted it since it was right across the street. So that worked out.
Yeah, and I think you've made some good points here. Who you choose as your property manager is absolutely critical. We've cycled through a couple of property managers that weren't quite getting the job done, but so make sure you're doing a good job, vetting them. And one thing Justin said that's absolutely key is just to make sure they have the systems set up to be able to do things properly. So and I'd recommend just having a straight out talk with them. What happens when you get your lead? What happens when somebody goes to the website? What is your internal processes for X? What's your internal processes for Y? We ended up letting a property manager go because we realized their internal systems were terrible. We had one unit that was vacant for 4 months that we had just put, $12 grand into renovating, and they couldn't get it filled. And when we started pulling the string, they just didn't have the system. So anyway, that's huge as far as that goes. And proximity to the property, I mean, that's also a big deal.
All right, Steve, you want to take it?
Yeah, sure. So for the market analysis, one of the things that we touched on earlier was the cyber center. Really what the cyber center is it's 2 buildings that were built in 2018, and they're beautiful. They were built for $100 million, and they're right smack downtown, right by the Savannah River. And it's really more than that. So they're a hub that connects the private sector, education, and government all together. And there's actually 75 cybersecurity companies that call that cyber center their home. And the economic impact of that overall is $2.6 billion annually. And this is the small tertiary market that we're talking about. Mm-hmm. Justin mentioned earlier too that we are in, and one of the things that we market is that if you look up this area for healthcare, it's more than just 1 or 2 hospitals, actually an entire medical center. And it actually has a level 1 trauma facility and unit. It's multiple hospitals that if you drive around it, it looks like a medical center. And then that has a $2.39 billion impact to the economy. And that is it's of the cyber center. They're kind of close to downtown. So if you've ever been to Augusta and you drive in that area, it's just lots of you see lots of construction, a lot of cranes and beautiful new buildings. And it's something that kind of combines like the beauty of the South with, you can just to see the growth. So it's, when you go out there, you get a feel for it, and it's just beautiful. The other thing is Amazon's coming to town. So they made this announcement while we were purchasing this. And really the nice thing about it is that it's 27 minutes away from the property, but the average pay for each employee is going to be $15 per hour. And they're expected to employ 800 new employees out of this facility. So it's going to be like for this property, it's a C property and basically a B area. So that's makeup of our tenant base. And so if you do some more research on Augusta, you'll see that they have a shortage of workforce housing for exactly this type of tenant or resident. So great stat for the property. Justin mentioned this earlier. So the population is 200,000 people, but if you look at the MSA, it's actually composed of 3 counties, and in those 3 counties, there's 600,000 people. So one of the things we've been taught to look for as coaching students is to look for populations that are at least 300,000 people or above. And that kind of meets that mark. And then another cool stat, it's most of the golf carts that are made in America are made in Augusta. We talked about the Gordon, but one of the things that actually is not talked about a lot, and I don't know if you want to touch on this, Brian, but the Savannah River National Laboratory actually has more jobs in Fort Gordon. There's 13,200 jobs based out of the Savannah River National Laboratory. It was originally built for nuclear production, and then it's evolved over time. But because of that, because of the medical center, because of the Savannah River National Laboratory, Augusta actually boasts the largest number of doctors per capita of any city. So,
so I think you said it very well. But what I will put out there is most of these jobs that are coming in are white collar jobs. Okay, and why is that significant? Well, there's a lot of studies that have been done that if a city brings one white collar job, it actually produces somewhere along the line of 1/2 to 3/4 blue collar job to support the white collar job. So you add 100,000 or 1,000 white collar jobs, you're automatically adding another 400 blue collar jobs to support the industry where the white collar jobs are. So When we talk about cyber center, when we talk about all the doctors at the medical center, when we talk about the national laboratory, and oh, by the way, national laboratory is full of a bunch of guys with PhDs, so we're talking white collar, high paid jobs. But what that also does, like I said, is it brings all the blue collar jobs to support the companies, to support the other things in the area that support the white collar jobs.
This is my last slide of this section, but one thing that we didn't put in our deck that I talked about during our actual presentation was the Masters. So there was Masters Week just now. For those of you who are remotely familiar with golf, it needs no introduction. For those of you that don't know anything about golf, there's 4 majors played every year in golf, and the first one's the Masters, then the US Open, the British Open, and the PGA. Typically, those rotate at different cities and different courses throughout the year, except for the Masters. It's always in April, except for this year because of the pandemic. It just happened in November. Dustin Johnson won it. But the course is one of the most beautiful courses in the world. It's top 3 always, and according to Golf Digest. And the economic impact of it is $120 million per year. And so the population of downtown Augusta actually doubles during the tournament. So it goes from 200,000 to 400,000. But even more importantly, from an investor perspective, is that the elite of the elite are members at Augusta National, which means they own property in Augusta, which means that even during economic recessions or depressions, the most elite of the elite own property in Augusta. So I have confidence that Augusta will stay beautiful for years to come because of that stat.
Yeah. So you said this is the last slide of this section. There's a couple of questions in the chat real quick. So one of them is about the property manager. What questions did you guys ask the property manager to vet them prior to?
We actually, I don't think I have a list of it, but we went down there and drove around with the property manager, with Philip, to look at his neighboring properties. So our big thing was comps. Comps for Steve and I kind of made or broke this deal, because we really wanted to make sure those were good. So when we went down there, we had him take us out for a day and visited what he managed in the area. We looked at the finishes that he did. We asked about what the rent he was getting. We were making sure the lawn was getting mowed. We asked him all about his processes. I'm trying to think. It was a little bit easier for us because Bernie, our other partner on this, had already been doing business with him for a while. So there weren't a ton of mysteries about, we knew he used Appfolio. We knew his reporting capabilities. We knew what response times were like. We knew how he handled turns. We knew a lot of that stuff ahead of time, so that gave us a little advantage. Okay.
Yeah, that's key right there. If you can visit some of the other properties that the property manager manages, you can see what they do with it. So you can see how well they maintain it, because you got to, at some point you have to put your renter hat on and start looking at things from a renter's perspective. You want to look at the curb appeal. Are things clean? Is the trash picked up? Are the grounds well maintained? That's huge for a lot of people who are coming to rent at a place. So if you can secret shop some of them, or even better, have them drive you to some of them, it's a good indication of how well they're going to do on your property as well.
The other thing too is I've heard a stat along the lines of 70 to 100 units is kind of the magic number in terms of having a full-time property manager on site and then a full-time maintenance person. And so since this is a smaller property, we obviously couldn't have that. But the big appeal to it was that we actually have the entire corporate headquarters directly. So it's like we have, an entire staff for our property. And the other thing we liked about that is that they work with a lot of investors. So if an investor comes to visit them at their corporate headquarters and they manage the property across the street and the property across the street doesn't look good, it'll be a poor reflection on them. So it kind of, just the simple fact of that property was what we really loved about it.
Yeah. Nice.
So I don't know how much, Brian, you typically dive into underwriting, but we did cover it on our investor call. So we had a P&L
So let's do this. Tell us some of the things that you did because of COVID, and just kind of walk us through. Everybody says they have conservative underwriting, okay, and that's something that you hear from every single syndicator. We underwrote this conservatively, all right. If everybody's underwriting it conservatively, then nobody is, right? But kind of walk through a couple of the things that you can pinpoint to say, we did extra conservative numbers here, we did extra conservative numbers there.
So the really these were kind of the things that we consider to be conservative. So vacancy, we were at what was it, 20% year one, 15. Let me back up now. Hold on. It's been a little while. 15 and a half year two, and then what is that? 11, 9, and I think I cut this off, but I believe it was 8 year 5.
Okay.
We underwrote to 5 years. We're talking about historically it's been in the 4 to 6% range for vacancy. So we obviously bumped up bad debt. For rent increases, so we didn't have any market rent increases happening the first 2 years. We actually ended up saying that we'd hit $800 in average annual rent by year 5. We're going to come very close to that year 1.
Yep.
We're still testing that a little bit. We actually went higher and we're kind of backing it down a little bit, but we're going to end up being, pretty close to that year 1. So we felt like we could basically get, today's market rents. We wanted to underwrite those at some point during year 3, if that makes sense. So obviously we can go ahead.
And for those looking at the screen, the very, I guess, second line down, annual rent escalator, 0% year 1, 0% year 2. Basically what that means is they're not banking on, year over year rent growth. And something to keep in mind is when your business plan is contingent upon rents going up and the economy going up, you're actually, it's a very risky proposition. Okay. So they're coming in with a 0% annual rent escalator, and the next line down, they are assuming that the expenses are still going to go up. Okay. So, that checks my box on conservative underwriting there. So if you have year over year rent growth, that's great. And then, same thing on the vacancy, a couple lines down, you got the income in gray. 2 lines under it, you have a vacancy, and then you have all the other stuff wrapped into one, the bad debt, the concessions, so you come back, the red lines, 15 plus 5 is 20%. So yeah, they're underwriting this property, or their forecasts on this property are based off of, only 80% of the units filled and paying year 1, which, you're probably over that.
The other big part is what you're predicting your cap rate to be when you exit. We were conservative. I think we said 6.5 at the time of purchase. It was well below that on average, according to everything we were seeing. And then we were factoring in 10 basis points a year so that we'd sell at a 7. So pretty conservative on exit valuation. Now,
you just pointed out that, if you look at your gross potential income, you are increasing that. Can you speak one more time on where that's coming from?
That would be just increasing rents. So basically, we're going to decrease vacancy a little bit, but we're going to increase rents over time. So what we're doing is the business plan here is we're turning units, right? So we're going in, and we'll dive in a little bit more about what we're doing, but we're spending some money to get better quality interiors to be able to get more for rent. So we're coming in at like $636 on average per unit, something like that. And that's with, interiors that just aren't really impressive, right? Like not good paint, not good finishes, not good countertops, outdated cabinets. So we're just going to go and make these fixes and then slowly start to dial up the rent. But we're still so far below market that we're not saying we're going to get to market rent until some point in year 3, if that makes sense.
I can add to that too. So some of the units were rented at a higher, so he had, the previous owner had rented some of the units at 760. And so we created this entire file, every single unit and the lease and the term out. So some of the units were rented at a lower rate and some of them were rented at a higher rate. And so as the natural turn happens, we offer the current resident their apartment at the higher rate. So it's not even that we're projecting rents to go up. It's this, we're making them all consistent with what they are. So some of them are even lower, like Justin's talking about, in the mid 600s, but he was renting some of them at 760. So we knew we could at least capture that.
So you got self comp. So basically the other units in your building are
Yes.
comping and you're just
Yep.
these up. Okay.
And then we put it into an entire schedule, year 1, year 2, year 3. And then every time there was a turn, we color coded it. And so it was a very accurate way of trying to predict gross potential income. It wasn't just a
All right.
ballpark.
All right. Good enough. Good enough. I think we're good with the finance one. That's an eye chart for anybody who's not familiar with that one. I look at that and I see numbers. I'm like the Matrix. Jerome and I have that in common. So
Yeah.
all right.
Yeah. I'll cover debt service. So we got Fannie Mae 10-year fixed, 5-year interest only. We were at 65% loan to value. So we had an $850,000 raise. Part of the big, you think about that, it's pretty big for a $1.4 million purchase price, but we were pretty, 65% loan to value, pretty conservative coming in, and then $240,000 CapEx budget. We were quoted somewhere in the what was it, Steve?
Well, this is what we were quoted right here. We actually got 3.77.
Not bad.
Right. Yeah. So not too bad. 5 years interest only. So
now let me ask a couple of questions on this. The 65% LTV, was that the max the bank would give you, or did you guys say we don't want to go over this? How did you get to that number?
That was kind of a pearl of wisdom from Drew. Because he basically said, based on the pandemic, let's go as low leverage as possible. So you guys for sure will be successful here, and that this thing will cash flow well. And it puts you guys in a really position. Maybe you won't get the home run by putting a lot of leverage on it, but it's a safer play, especially considering the pandemic. This is your first deal, so conservative for the first one.
Yeah, and something that I learned after signing my first loan is, if you give a little bit on the loan to value, the lenders can play with things like, the interest only term. So if you're really stressing that loan to value, and you're trying to get every penny out of the bank that you can, they're going to come back and they're going to give you less interest only time. And so that 5-year interest only is huge right there. And I think it's a really good play because, they are going to be able to cash flow a little bit more. They have a lot less debt service they have to worry about because they're at 65% LTV. They got a smoking hot interest rate, and 5 years interest only is killer. So I think that was a smart move.
Yeah, we did have 75% loan to value options, but that wasn't an option to get 5 years interest only. So it was good on the numbers.
Yep. And somebody asked a question, is it normal to see interest only for 5 years? No, it's not.
Pretty rare.
It's usually like 2 years.
Yeah, 2 to 3 years, I think, is what you can get. But the lenders are going to look at the overall risk profile of each deal and the deal sponsors, and that's something they can play with as long as they're not stretching the limits in other spots. All right. I'm looking through the questions. There's a question about the cash on cash returns. Is that a later slide? Oh, here it is.
We got, right here.
It's right in front of me. There we go.
So this is what it penciled out to with the model. We use Michael Blanc's SDA. So 14% IRR, 21% average annual return, and then 11% cash on cash, which is higher than what you typically see. But part of it was because of that loan, and part of it was from the single family house.
80-20 split, by the way, for those that are wondering. So just we didn't do there's no pref, there's no hurdle. It was pretty simple. So just a basic split, $50,000 minimum investment.
Okay, so the house, I mean, is it on the same plot of land or just same owner, same area? What's up with the single family?
It's on the same plot of land. It's basically directly east of the property, and so it's all one deal. But basically our plan is to spin this thing off and sell it if we can. We had projected to do it in year 2, which is why you can see on this the cash flow increases. So right now we're we're just fixing it up and renting it out to be able to get cash flow on it immediately. But the opportunity exists in the future to sell this thing as just a single family home, probably to like an investor. I mean, it's right next to the property, so it's not going to be your typical, somebody will probably buy it just to rent it out, but it'll make operations for us a little bit easier because it's kind of this, we got 28 2-bedroom, 1-baths, right? They're all in these buildings, very easy to manage. And then you've got this other single family home. It's just kind of the outlying factor there. So we'd like to spin that off.
Okay.
Let's see. So we went into a little bit about just, basic stuff, right? How we communicate, what our plan was for monthly updates, quarterly distributions. We didn't promise any distributions year one, just because we're putting so much capital into these buildings that we didn't plan on paying distributions. So, this was in August. We're 3 months into it. We're ahead of pro forma on our numbers. So we'll see what happens, but we want to kind of under promise and over deliver on the distributions for this. The business plan. So increase NOI. Does that sound like a good business plan? Pretty basic. Going from 636 to 800 over time, putting in some management, better management, really just giving this thing some love because, when you walk through this, it was kind of like the hallways smelled and, you'd walk in and the paint was bad and it just hadn't been updated. And we really feel like this area has such potential for higher rents, but a higher quality of tenant and it's it's an area that's moving up. So that's our plan. We started to do this already. I think I have some pictures. So interior rehab, we're budgeting just for the interior part of it, $6,500 per unit. Doing LVP, repainting the cabinets, new appliances where we need them, paint, new hardware. We did do new lighting, LED. So this is what it looks like after the fact. We've been able to turn, I think, 4 of these, right, Steve, so far?
Yep.
So, just basic stuff, but, new brushed nickel on the fixtures, white paint, new hardware, all the basic stuff, nothing too crazy. The exterior, we spent a lot of time on. You can see what the paint looked like on this building before. We updated all the paint. We put a brand new, we didn't really rebrand it from like a naming perspective, but we put a new sign out, put some flowers on it. We've done a lot of landscaping to it so far. The other thing we're working on is this laundry room. So basically what they had was they have 28 in these 4 buildings. They have 28 2-bedroom, 1-baths, but one of them they actually split out and they had it as a leasing office, which didn't make any sense.
Yeah,
in any
28 unit. No.
Yeah, it just doesn't make sense at all. But for us, it really didn't make sense having the having the property manager right across the street. So we are actually going to turn that into 3 washing and drying machines to offer on-site laundry. It's probably a wash as far as if we just had that as a bedroom and rented it out. It's probably actually even a little less, but it's the type of community that we think really deserves to have laundry on site. So from a resident retention standpoint, it was something that we thought made sense.
So a couple questions on that one. Where's the closest laundromat?
It's actually not too far. It's up the street, maybe less than a mile.
Okay, but if you're doing laundry, you don't want to go, up the street a mile. And I would assume no hookups if you're putting on-site laundry.
No.
Okay. And then are you guys using a service or are you guys buying the laundry machines and sticking them in?
We're contracting it out.
Contracting it out. Okay.
Yeah.
Smart. Okay.
Yep.
Got it.
So we had to do that. We basically turned that into an office and put new plumbing and electrical in there to be able to have that third party come in and start installing the machines. So rent comps, we did a little bit of a presentation on what we were thought. We pulled what we could, like CoStar, we had CoStar, we had these apartments.com. Really what we did though is we picked up the phone and we called a bunch of places to see where we thought we'd land, right? This is kind of what it came to as far as a visual, was pulling some things to say, hey, in this area, you're getting anywhere from 93 cents a square to $1.28 a square. It's really all over the board. It's an interesting area because this Somerville area, if you see this, just northwest of the property, very nice old money, there's a university up there. It's kind of like all these big old homes. And then you've got south of Wrightsboro here to the southwest is more of the typical C-class assets. And you've got A-class to the right of it. So as you go right, you're going towards the river, towards downtown, and that's where they're building a bunch of A-class. So it's really all over the place. It took a lot of diving into the numbers, driving around, calling places to make sure that we had the comps right. But we presented a very conservative case for our rent.
Okay. Question from the chat. Do any of the comps have on-site laundry, especially the C-class, the direct comps?
Yeah. Okay. I would say most of them did.
Yeah.
I'd say, yeah.
Okay. So from that perspective, if you're not offering the on-site laundry, that's actually a negative thing for renters coming in.
Right. Yep. Yeah, it needed to have it for sure.
Okay. All right. So one more question. Let's see. There's several in here. I'll just hit the one. Back to distribution. Sorry, several slides ago, but you said no distributions year one. Any complaints on that one, or were you guys? How did you pitch that to the investors?
I didn't have any kickback, although I guess the people that never invested might have had some issues with it. But no, I think it made sense. I mean, the way I kind of pitched it was like, we could pay you distributions out of the money we're raising from you, right? Because we're putting so much CapEx into this thing. The reality is like we would over raise to have to pay you year one, really. So that's kind of what I told people. I don't know if it made sense or not, but I didn't get too much kickback.
In our model too, we do have it projected at $2,200 for year one. Yeah. So on a $50,000 investment. So there really is, but it just kind of is more in line of the setting the expectations. It's not going to happen right away. If it does, it'll be towards the end of the first year, month, 6 and 9. But we didn't want to overpromise and underdeliver.
Right. All right.
So sale comps, I mean, this is something again where within the area, within central Augusta, you had all these A-class, B-class. I mean, the comparable properties in C-class, there weren't a ton, but we were in at 48 a unit. We were getting rents right off the bat at 636, being able to push those over time to 800. So, bottom line is we're getting a pretty good deal on this thing. There was a lot that's been trading, especially now I'm seeing it seems like it's trading mid 50s. I just talked to one person, they're under contract at like lower 60s. I mean, these aren't total comps for this, but basically it's a pretty good deal. It's probably on the lower end of what things were trading at the time. So that's it. In our presentation, we went into a little bit more about how it would work as far as funding money and that sort of thing. We wanted to talk about some lessons learned. On the capital raising side was a big kind of learning curve for us. So, I think a couple of things that I have as far as takeaways from the capital raise are, first of all, don't let your foot off the gas. I did have 2 investors that backed out. I'm sure that's happened to some people on the call. It will happen. I think part of the thing that we struggled with, I told you the story about how this deal came together, right? We had it Bernie had it under contract, and then we came in to help it. And basically what that caused was we were a little bit all over the place as far as our timing with our investors, because Bernie had talked to people and gotten verbals from friends and family. He was pretty good. So we had to come in and start the whole process over. So we were all on different pages with our investors just naturally. And so for me, the situation personally that it created was I had 5 people that were verbally committed that were going to fund my portion of this deal. So how do I then go out and talk to a 6th person? Because I don't want to get them excited about it, and then they can't actually invest in it if my 5 come through. So I struggle with that a little bit. Lesson learned is obviously have a very smooth timeline, a very strict timeline about when you're going to do things like have the webinar, allow people to sign the PPM and start wiring funds, and just define it up front, because not having that coming into it, it was like herding cats, truly. So So keep that in mind. We actually ended up doing a recorded webinar instead of a live webinar, just to be able to send out to people. That worked pretty well. It avoided any technical issues. For sure, the way to do it, I think, is a live webinar if you can, so that people can ask questions live, because a lot of the people that you shoot that video out to are going to have those same questions at the end of the call, and they can just get them answered by watching the webinar. The other thing that came up was getting familiar with something like DocuSign. If you're going to have people sign PPMs, subscription agreements, have that stuff in place, because we were like approaching the deadline trying to figure out how to get our PPM into DocuSign. And thank goodness we had it, because we actually had an investor that was on vacation the week prior to closing. And if we hadn't had something to send him where he could just go on his phone and click, 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 be done with it. Can you imagine like trying to email somebody in, the Caribbean, a PDF that he has to go to the front desk to have printed out and sign and send back? It would have been a nightmare. But the point is have that stuff kind of figured out and know how to use it, because you don't want to be wasting valuable time during the raise figuring out the technical aspects of it. So that could be a DocuSign. It could be, your investor, if you're going to use an investor portal, whatever it is, get that stuff kind of figured out now. Even your presentation deck. I can't even tell you how many hours I spent on Canva putting this deck together, right? It was a ton, and it was happening during the raise, right? So create that beforehand, put together a template, or maybe it's your, what do you call it? Your sample deal, right? And then when you find a deal, all you're doing is plugging in pictures and a little bit of language to make it really smooth, versus trying to create that thing from scratch when the clock's ticking.
In terms of the lessons learned from the capital raise too, Justin and I both were very intentional about this. So we, before going into it, decided that we were going to make some content based upon our raise. So that, and I did that separately. So he has a presentation that he put together on his lessons learned specifically from the capital raise. So if you want that from Justin, you can email him after this. And I did the same thing. So what I did, and I would encourage you guys to do this as well, is I kept a daily journal the last 30 days to close. And I would write down just in bullet points, here's what I'm feeling right now. Here's what happened. And I didn't expect that. Oh, I talked to Brian Briscoe today, which I literally did. And I had an investor drop out on me, and this is how it made me feel. And this is how when someone says this to me in the future, here's what I need to say. So I did that with Brian. I did that with one other mentor I have in the OKC market, and found out what the appropriate responses were to those objections, so that when I got them in the future, I would know how to handle them with confidence. Yeah. The other thing for me from the capital raise was that I kept track of all my stats. So Justin and I are both in sales. I'm very numbers driven by it. So I put it into a spreadsheet, and if there was a yes, it was a 1, and a no equaled 0. So I could easily quantify it for each investor. So I had separate columns, a column for, did I do a Zoom call with this person? Yes would be 1, no would be 0. And I did that for, what else? Text conversation, emails. Did they watch the webinar? Did they want the slide deck by itself? So for every single person that I talked to, I had either 1 or 0 in that column, and then I could quantify it at the end. So at the end of it, I had talked to 87 people and got 5 investors. So 5.7 people that I approached about this deal or talked to in some capacity and invested. So that gave me a baseline. Now it just turns into a numbers game for me. If I want to raise X amount of dollars, I assume a 5.7% conversion percentage, and then it just turns into a numbers game. That's how many people I have to talk to.
Yeah, I know a lot of people do keep those numbers, and I've had some people share them with me. And they're people, you'll get better at it, number one, because you'll be able to I guess weed people out earlier. Let's see, going back to the chat room. All right, one question, and I'll just take this one. What would you do if you're overfunded with investors' money? That's a great problem to have. That's all I got to say. Great problem to have. Lots of things you can do. On our last deal, we were actually overfunded, and one of the GPs just decided to put a little bit less money in. So you could also just raise more. I mean, a lot of people just be conservative, say, if you think you need, 850, you raise 900. You could just accept the money and you just have a little bit more in reserve. Or you could just say, hey, sorry, and when we're fully funded, we will start a wait list, and just say, hey, look, you're number 1 on the wait list, you're number 2 on the wait list as well. So that can help as well. Anyway, all right. Question from a lot earlier from Peter. He said, what were the top 3 risks associated with this deal, and how did you guys manage them?
COVID was one for sure.
Okay.
The loan, getting less leverage on the loan. We didn't know the CDC moratorium was going to come out. That happened, and so that was definitely a risk. But not being able to raise was another one. And having Drew as a KP on the deal, I think, gave us credibility. The fact that we were all together. This is the first. Another risk was this is the first time that this team had done a deal together. And the thing that really makes it work is the level of respect that all 3 of us have for Drew. So whenever there's a tough decision that needs to be made, if we couldn't make it together between the 3 of us, Drew would be the default, person that gets to decide. So we had those risks, and those were our solutions to them.
All right, go ahead.
I was just going to add, I mean, the risk in a lot of these things is always will the business plan be executed? And so we manage that through having a good team. And I think that's probably always the answer, other than the COVID and the external things. It's like, is what you're telling me is going to happen actually going to happen? So we wanted to make sure we had some experience on our team and some people that were really just dedicated to making it work.
Okay. Jerome's got a good question. He actually had several very amazing questions. As far as, GP, is it just the 4 of you, the 2 of you, Bernie and Drew?
It's just the 4 of us.
Okay. And none of you guys are in Augusta. All right. Which is kind of, one of the things lenders look at, and this is more educational for everybody else. One of the things lenders look at is they want to have boots on the ground. Sorry, my COVID's acting up. Just kidding. But usually you can sidestep that hurdle by bringing your property manager into the game, and your property manager will have to fill out some forms for the lender. All right, and one question about the legal side, and just because we're a little over time, let's make this the last question. Looking about LLCs, what's the legal structure of the deal?
So there's a LLC based out of Georgia, and then we have a holding company that's based out of Texas, and then our general partners also have a company. So there's 3 companies that were formed. We did the Georgia company because Georgia charges a fee for out-of-state sellers. So that was just the wisdom from our attorneys. They told us that on one of our initial meetings, and they're like, do you want us to reach out to a Georgia attorney to get that set up for you? And we came back and said, yes, please do that, so that we didn't have to pay the fee when we sell the property.
Okay, so the property is owned by the Georgia LLC? Correct. Okay. All right. And then the GPLP split, is that into the Georgia LLC, or is that, I assume that's how it works. So the property so the Georgia LLC holds the property. And so inside that Georgia LLC, you have a GP and you have an LP, correct?
Yes. Okay.
And the holding company, is that part of the GP structure? So explain that one a little more. I got lost in that one.
The Texas, where we did the operating agreement was out of Texas, which would have our structure, our company agreement, our company formation that then owns that Georgia entity that owns the property. And then, of course, we have our own LLCs that we, everybody individually has their Justin Elliott LLC or whatever.
All right. So to simplify it, yeah, I mean, the simplest way to do it is just to have a single LLC. Obviously, get an attorney who's familiar with multifamily and get your CPA involved. And between your attorney and CPA, they're going to talk about the legal structure to best protect you and how to make, the best use of your tax dollars. So, all right. Let's see. I think that's about it. Actually, I said that was the last question, so I forgot about that. So thanks, Steve. Thanks, Justin. I appreciate it. And I think we're at a really good spot right now. So just for everybody's, what we usually do after the presentation is we do some networking. Okay, so what I intend on doing is opening up some breakout rooms and dropping everybody into the rooms, give you a chance to meet and greet people. So what I'd ask is, if you're going to hang around for networking, hang around. If you're not, now's probably a good time to punch, if that makes sense. So, all right. And all right. So I'm going to open up 4 rooms from now, because we'll still have 1 or 3 people drop out. And ready, set. Oh, timer. Okay, what we're going to do, let's see, it's about 10 after 8 o'clock my time. We'll do 3 breakout rooms of about 13, 14 minutes each. And here we go.